You humbled beasts, I am Dave Worrell. Welcome. I'm so pumped to be here. I hope you guys like the new branding. It's just my name now, so we're done saying Lo-Fi Trader, but listen, guys, if you've been with me since Lo-Fi Trader, thank you. I do appreciate you. That is a page in the past, but the OGs will always remember it as Lo-Fi Trader. If you don't know why we're here, Papa Powell will be speaking today at 1:15. So I got you for about an hour and 15 minutes. What we'll do is we'll go over the overall market so we can get an update on what's going on. And if you were with me during our Discord, this morning, we did this briefing already, and now we are still just trading sideways, so we'll revamp exactly what we said. If you're watching this and you're just joining us now, we are live. Make sure you click that live button at the bottom. Make sure you hit a like and a subscribe if you find this entertaining, or if you find any value to this, to your life, or just in general to the market conditions, understanding if it's fruitful to you. Hit that like, hit that subscribe. We work very hard every single day, the whole team, on editing these videos, bringing you out the best data, the information, and doing analytics. If you have any questions or anything, please throw them in the chat section, and we will be sure to get to you. I am very interactive, and I'm very good at what I do. So, ladies and gentlemen, without further ado, let's hop right into the S&P 500. I have a lot that I would love to go over with you, so let's just go ahead. We already got our first chat here. I sure hope gets out of my hopium pipe. Yeah, Powell has something encouraging to say from the market. It's fun watching your retirement shrink. Invest, they say. It'll be fun, they say. That's from Bob Bob the Builder. Good to see you in here, brother, right off the get. Yeah, you know, and that's one thing that I'll reinstate here. When we have a lot of fear in the overall market, when we have these geopolitical issues in the overall market, the Middle East, the tensions are rising. So when we have those types of fears, the biggest thing you're going to see with Jerome Powell is and this is usually, right? We don't want to say this is exactly how the meeting is going to go, but usually you'll see these Fed speakers, they're going to come out and they're going to say, hey, look, I'm dovish, right? Dovish, hawkish, if you don't know what that means. Dovish means he's going to come out and be a little bit lighthearted. Yes, we will be giving rate hikes. Whatever his plan is, he's going to come out and seem a little bit not as angry, not as we are staying the course. You know, he's going to come out to be a little bit more relaxed. He's going to try and show the people, because we don't want this market pullback to turn into a tailspin and a crash, right? And that's what you're going to see usually from the Fed speakers. Nylish is in the building. Good morning, good afternoon, actually. I'm still waking up. We got some go-go juice here, so we'll be cracking into that real soon. But Nylish, it's good to see you, brother. I'm glad that you could make it. I'm glad you got some time off work, man. You're always working, brother. So it's good to see you in here. It was good to see you this morning as well in the Discord. That's very, very awesome. And Bob, if you get a second, actually, I'm going to give you rights. I'm going to give you moderator. Let's see, add as a moderator. So I'm going to, let me see here. I'm going to give you standard moderation rights, and if you could go and share our Discord, Bob, I would appreciate it. Share that in the chat. For any one of you who are just joining us, maybe you're just watching this as it's been recorded, which is very popular, check out the chat. We got Bob. He's going to throw that in there. And you guys you're more than welcome to join our Discord. We get together every morning at 8 a.m. and sometimes we have a nice study session like we're going to tonight around 8 p.m. So we get on at 8 in the morning, 8 p.m. and we go over everything what I'm going to do right now here in front of you. So you get a little taste of what is going on. The Predator popped in. If he smiles when he takes the mic, we're done for. Oh man, that's hilarious. Yeah, if old Papa Powell hops on and he gives a big old grin, we are SCREW'd, if you will, please. So, all right, guys, let's go over the market. Now, this morning, if you were part of our Discord, I said that I expected a bounce into the 50-day moving average. We did not get that bounce. We did not get that bounce. It's very, very sad to say, because I couldn't pull on as many shorts as I wanted to. Now, I'm in 2 shorts right now. It's the only thing I could really find in the market to take a short on. But the great thing about this is the faster we pull back, the harder we pull back, the more I can get into my long-term account. So I'm happy to say if we continue to pull back for the rest of the day, I'm probably going to be adding into my VOO or my VTI, my long-term investing account, which is great. We absolutely love to be able to do that, right? We love to be able to add into our long-term account because we all know the S&P 500 averages on over the course of the past 100 years, on average each year, returns of between 8 and 11%, and that is with your 2% inflation. Now, speaking of inflation, we do want to get that Fed wants to get, I should say, Jerome Powell wants to get that inflation down to that 2%. Now, there's a lot of talks on if that's even plausible, if that's something that can possibly still happen, or if the new norm is going to be 3.5, whatever it is. But he has been very true, very, very hawkish when he says it, is I am determined to get inflation back down to 2%, and he's willing to do it at all costs. Okay, so that being said, I think we're going to see that we aren't going to be getting those the 3 rate hike cuts. I don't think we're going to get those by the end of the year, and we'll go over that in a real little bit. But let's go through the market and we'll see exactly. Thank you, Dan Bob, for throwing the Discord in the chat. You guys are more than welcome to join that. We have a free trading course that'll be coming out soon. We've been working day in, day out, Adam and I, Covey, getting this trading course up and running for you. So that way, when you join the Discord, you have something on YouTube to look at to know exactly how we trade during a bull market. Okay, guys? We want you to know exactly how we trade and how we trade it because, simply put, we don't want you in there and lost, right? Why are you using these moving averages? Why are you doing this? Why are you doing that? So right now, we are in a pullback. We're in a correction, and that can be beautiful for you investors that are out there. So shout out to the investors, baby. All right, so let's go through the market for the third and final time. S&P 500 now below a 50-day moving average. A huge pullback here, and I say huge, but let's just go ahead and measure this from the all-time highs, and we get a pullback right now of 4.25%. With the overall market usually moving about 1%, we can't really call this huge, right? Around 7% is where I'm going to start saying we're at a pretty big correction here, right? So we're only at a 4% correction, but when we're below a 10-day, a 21-day, and a 50-day moving average, that is when I'm hands off the market. I'm not finding the swing trades like I usually do. I like to play those trend breaks, and I'm not finding any of those trend breaks in this market to try and catch a bid to go to the north side. So that being said, I'm hands off unless it's a short. I'm looking for those pops and I'm looking for those pullbacks. So right now the S&P 500 leading the way to the south side below a 50-day moving average, now trading at 504.11. Next up is going to be your the QQQs. So the QQQs are also well below that 50-day moving average, right? And why do I say S&P 500 is leading the way? Well, because it was the strongest for the longest, right? It was outbeating the NASDAQ right towards the end there. It was beating the Dow Jones Industrial for a while. It was beating the QQQs after Jerome Powell, the last push in March, okay, when he talked about getting those 3 rate hikes or 3 rate cuts. And so now the S&P 500 is the strongest. So that's my main watch, and it has been for years. But that's why I say it's leading the pack, because that's where I'm going to want to see the S&P 500 start to turn around, start to show some better news, and start to head back up to the north side. But speaking of the QQQs, we have the QQQs here, and we have it well below a 50-day moving average, and we are not seeing a significant pop here, which, to be honest with you, I was really expecting a bigger pop than this. Right now, we're just trading sideways, which can be a positive side of things. At least we're not continuing to fail. But after a huge drop in the QQQs, just in one day, one trading day, this thing usually only moves 1.2%, and we went from a high to a low, and we're down 3%. So we made a move in a day 3 times its average expectancy, guys. So we need to be really careful out there, because if there's more fear in this market with the geopolitical news and things like that, we could really, really start heading down even faster here. But I do expect a bounce. I expect a bounce. Now, this bounce with the resistance at 433, we might bounce into this resistance and then start pulling back there, but at least we will have a bounce, right? So keep that in mind. Next up will be your Russell 2000, your IWM, or your small cap stocks. We look at the small cap stocks because the small caps has not gotten much movement at all since back in 2020. It came up and channeled sideways. After 2021, it came down with the rest of the overall market. After it came down, it traded sideways. Even with the overall bull market that we have had for so long heading to the north side, the IWM just traded sideways. It really didn't do much at all for us. It wasn't the prettiest look, but I will say this. Now the fact that we are breaking these lows, can it even hold that 200-day moving average? We're sitting at 195.19 right now, and the highest it could make out this year is that 212. That 212, well, more, closer to 211.50, guys. Let's see, it's showing 212.47 it hit in the aftermarket. So 212.50 was its absolute all-time high before just relinquishing all of those gains in a very short couple of weeks. So now sitting at 195.19, IWM is not looking pretty. Now the NASDAQ is also leading its charge to the south side. This looks more like the QQQs rather than the SPY. So the NASDAQ is pulling back. You got 100 stocks in that, your leaders of the overall market. Now, one of the ETFs that I absolutely love to look at, and if you aren't watching these, you have been living under a rock pretty much this whole bull run, and that's SMH. SMH is your semiconductor ETF. There's a huge reason why we want to keep an eye on this, and that's because, first of all, let me turn on some music here. I don't know if you guys can hear that music. If you can hear the music, let me know in the chat, please. Just turn on a little bit of that lo-fi music in the background, baby, so we can always revert to the mean in case we get a little too excited. We got to keep it nice and chill, baby. So SMH is your VanEck ETF semiconductor fund. We always want to keep an eye on this, and it looks like we're getting that bounce on the 50-day moving average. Why do I want to continue to look at semis? Well, if we look at the overall market, well, it's pulling back. The SMH, or all of your MU, your NVIDIA, your AMD, your Taiwan Semiconductor, they're actually holding on to the majority of this pullback. We're not seeing a huge breakdown. Now, we did see it pulled back originally and just traded sideways, which is very constructive in an ETF like this. So when we see it pull back, we see it holding a 50-day moving average. That is a positive sign. Now, I'm not saying it's going to bounce and go right back to all-time highs. What I'm saying is when we start to get a correction back to the north side in the market, if the SMH is still holding most of its gains compared to the rest of them, we can honestly just take a look back into those semiconductors, find out what the leader is, and we can continue to play those to the north side as long as they're showing our setup. Mine is trend breaks. Ours is base breaks. We have a lot of different strategies, but the main ones that we like to use in a bull market, mind you, is those trend breaks, those base breaks, and even those episodic pivots, or as we like to call them, because it's not very specific to the episodic pivot, is a gap up continuation play, right? We're finding what gaps up and what has those continuations. And today, we'll just go off side course here. Today, I actually took an episodic or a gap up continuation play to the south side on a 5-minute range break. I actually took it on a 1-minute range break, actually, because it was moving really fast for it being such a big boat of a stock. And that's ticker UNH. UNH had earnings come out here, and it gapped up, way up, about 7% when this thing usually only moves about 1.6%. I decided to take a short here at the 1-minute opening range break. I'll just zoom in here so you guys can get a little better peeky gander. And once it broke this 1 minute, I ended up getting in a little later than I wanted to by about $1. Let's see here. Yeah, about $1 chase here, guys. So I don't like to admit that I'm chasing, but listen, you're a loser unless you're learning, right? And I knew I chased. I called it out that I chased. But here's the thing. Once we flushed through, I exited about let's see, about 1/5 of this position. Okay, I exited 1/5 of this position, so that way I could protect some of those capitals. Now, if we come back up here and I break out for break even, at least I'll make a small amount on this trade. But I needed to protect that capital, and I needed to protect it immediately. The only other short that I have in so far today is NVIDIA. Now, in NVIDIA, we've had a nice pullback. I'm only up about $100 on this trade. I'm only holding about 25 shares short. I will exit some of this position the second it breaks through this downtrend line. So now I'm playing the same type of plays that I am, only I'm reversing those plays. If they break up through, I'm exiting rather than going long. If they hold it stay, I'm going to continue to hold to the short side. Now, these are day trades. I don't like to recommend anybody playing any type of day trades because if you're not used to day trading, you're usually going to lose money, especially learning. So if you're trying to learn, use paper trade or take very, very small share sizes. And that being said, I always speak about risk management. Remember risk management, ladies and gentlemen. Now, if you're just joining us, remember in 1 hour, we have Jerome Powell coming out, my guest speaker, if you will. I'll let him take the mic. I'll let him say the things that he wants to say because old Papa Powell has a lot that he needs to go over in the overall economy. Now that we are talking about slashing these rate hikes, which we'll go in just a little bit, he was talking 3, and he was talking that he wanted to stay the course on those 3 rate hikes. I'm sorry, on those 3 rate cuts. Now you have a lot of Fed speakers, you have a lot of people coming out and saying, we aren't going to get those cuts, that we are only going to get 2 cuts. I've even heard 0 cuts. But if we use the Fed rate tool, we can see exactly where we are at on these. And we'll just go ahead and we'll bring it up right now, guys. I'm pretty excited to talk to you about this. Now, if you look at this data, it shows here in May, okay, over this way, attention that way. In May, right here, we are at a 93.9% that we are to stay. So May to stay, right? So next month, when the speakers come out and they start talking, we are most likely to stay in the market because we have a 93, almost 94% likelihood to keep our Fed rate at 5.25, 5.50. So no quarter rate cut, okay? So that being said, thank you, Sam. I'm glad you're here. That being said, let's take a look at June. So now our rate cut expectancy in June is now only 19% for that quarter percent. If you guys look right here, you will see we only have a 19.2% expectancy to come down a quarter of a rate hike. I seen this as high as 26% about a month ago, okay? But after CPI index came out, after we had PPI data come out, which if you guys aren't aware of it, we go over that all the time. We have all your bite-sized data that talks about all of these cuts. That's how we know before it's gonna happen. Before, when the PPI comes out and it's hotter, when you have less people filing for unemployment and you have more people working, showing a very strong economy, you would think that's great for the market, right? Well, it's not in this case because with inflation, sticky inflation, holding on to the overall market, Papa Powell ingests this data and says our rate hikes aren't doing enough. So at 5.5%, we can't lower it now. If we lower it now, inflation's still going to keep on rising. So right now at 5.2 and 5.5, they plan on staying with only a 0.25% rate hike due in June at 19.2%. So that can be very, very interesting for the overall market. What happens if we don't get rate hikes? Well, I'll tell you this, or I'm sorry, rate cuts. I'll tell you this. The second Papa Powell or the federal government, and this, you can go back and look at all this, the second the Fed steps in and says we are slashing interest rates, we are going to start bringing down interest rates, you can see the market go crazy. You'll see the market go up, 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 and that's what the market does. It takes in this data and it tries to lock in exactly where it thinks it's going to be after a certain period of time, okay? Been studying this for an awfully long time now, and it's beautiful to see, but I feel like so many people know it because there's so much data out there, so many people who would ingest this data, so the market is doing its best, like it has done for 100 years, to take in all this information now and price in the future's price, okay? So right now, it's ingesting this data and it's saying we only have an opportunity to cut rates at a 0.25% at 19.2% in June. So this was much, much higher last month. Now that it's coming down, our opportunity for the market to go up is less likely. Now let's look at June. So June is when we actually start to see a higher percentage, but it's still not even at 50%. Those aren't odds I like to see. We actually don't start to see a rate cut hike till we get about closer to 50% in September now, okay? So September is looking more like a Fed rate cut. So Papa Powell is gonna come out today and he's gonna start talking about what he plans. Now, if it's the same old talk, if it's the same old expectancy when it comes to this, then he'll say that he's staying the course. He'll say, hey, I still plan on cutting 3. I still plan on staying the course. I still think everything's going on great, because to be honest with you guys, he has said many, many times when people start freaking out, they start saying all these things. He goes, hey, when the data was really low, we didn't overcorrect. When the data is really high, we're not overcorrecting. They don't want to overcorrect because those Fed rate cuts are like a whip. Okay, he might take it and he might slap it down now, but you're not going to see those cuts for another 6 months. You're not going to see what effect it actually has on the overall market for another 6 months. Okay, and maybe not so much the market trying to price it in, but as well as businesses, you know, as well as homeowners. I mean, it affects everything, guys. So we have to keep that in mind. Now, back to the overall market. What I want to look at, guys, is gold, GLD. It's been a huge talk and it's been on the rise, which, speaking of gold, my main watch, HMY, which is Harmony, okay, Harmony, I am waiting for this thing to set up like it did right back here. Let me just go ahead and blow this up. Let me maximize this L. If you see this, you'll see why I trade these, right? Right here, I missed my one gold opportunity so far this year, and I'm waiting for my next one, which might be coming up now. Now that we have broken this downtrending line, my stop would have been at its low of day, or when it broke out previous low of day, the 10-day moving average at 748, and this could have carried on higher. Now, me missing that opportunity, I'm waiting for another pullback, and you can see it starting to happen here. Now let me zoom back out and show you the hourly on the HMY Harmony Gold trade. So we'll throw this up on the hourly, and now you can start to see this happening. Now, I don't want this to take off today because it has such a wide range here. I would like to get a better dollar cost average, or a better risk to reward, mind you. So when you see something like this and it's hitting these, I don't want to play this right now. I don't want this to break out right now. I want it to pull back. I want it to get tighter under here before it breaks out higher. But the only thing I'm looking at longing in these type of markets are your fear, right? Your fear is going to be your gold. People tumble into gold since my grandfather's time. They've been tumbling into gold when fear starts to set in. With these geopolitical tensions in the Middle East right now, we can see gold has been on the rise. Now, we are a little late to this because I didn't catch it in the very first time, but when you look at GLD, let's take a look at GLD, ladies and gentlemen. Right here was the breakout. Let's go ahead and look at the weekly. If you were with us in the Discord, I talked about this weekly break, and it broke out, and it broke out very, very hard, guys. And it has not looked back on the weekly, right? It tried to, but it didn't give up much of its gains, right? We're heading back up to that all-time high of 225. Right? That 225 won't stop. Can't stop, won't stop. Rip, rip, tater chip, baby. So this thing is continuing higher, and I'm waiting my turn to get into this so that way I can be a part of whatever's left of this gold market run. The only other thing I've been looking at is the energy. Now, we can see that this area that I drew out for you is going to be its retest. And why do I say that? Well, let's zoom back out here and let's look at the daily. The daily right here, you can see on a very multiple time frame, it came up and showed resistance at this 119 area. 1, 2, 3 different times, a big cup, and now it's creating this handle. What does a cup and handle show you? It shows you psychologically that you have investors that have been dollar cost averaging in, holding on to their buys, and then they aren't willing to sell. If they're not willing to sell and this doesn't come back down from where it's at, it's likely to go higher because your supply is going to be higher than your demand. okay? We can obviously see we've had some demand here. Now it's back, sitting back down here in its supply. If it breaks through the supply, then it will show we have more demand. It's simple economics here, people. So XOM, if it wants to continue to break down from here, a little pop and a short might be good. But if XOM, and why am I looking at XOM? Because XOM is your biggest entity in a lot of your energy ETFs, okay? If you look at XOM and the way it's trading, and we look at energy, which should be XLE, the ETF, you'll see it looks damn near the exact same. Look at this. You would think we're looking at the same damn stock. This is not the same stock. This is XLE, the energy ETF from Select Spiders, okay? This is the Spider Select ETF for energy. So we're seeing that we're getting a lot of chop in the pre-market and it's starting to head lower. If we go over to XOM, you can see the same thing here, guys. We're starting to head lower, okay? Lots of chop in the pre-market. We are starting to head lower. Now, what I'm trying to tell you here, though, is we are at its area of support. If it can hold on to that support and we can head on higher, that will be absolutely beautiful. Troy Wiseman's in the building. I'm sorry if I'm just getting over to this, but he is late, but he made it. Hey, better late than never. And you're not late, actually. You're here right on time because old Papa Powell doesn't come out until 1:15. So you actually made it here on time. I just thought I would get on here an hour early so I could yap and babble before my good friend Papa Powell, my special guest, if you will, shows up and takes the mic from me. Also, this too, a lot of your other YouTubers who are trying to stream this aren't doing it the way I'm doing it. We actually have this. I actually signed up for the Wilson Center to get their direct live stream. So you guys are gonna be getting it here first. Even it might only be a couple seconds faster than the rest of them, I got reason to brag, baby. So that's gonna start at 1:15 and he'll be actually talking until 2:15. I'll be right here with you listening, ingesting the data, so that way we have exactly what we need to have, and I can bring it to you here first like I like to do with everything. Now, back to energy. XOM looks absolutely beautiful with all of these wicks here. So a lot of this, what this wicking will tell me on the hourly, guys, like we'll just zoom in far. See this big wick here? That shows me that there is a lot of buyers buying this up. It's soaking this up right here. Now, if we continue lower, I'm expecting a pop and then a big sell-off with the demand. But what I see right now is we broke down, we're having a shakeout day, it's getting bought right back up, and if it can hold this area, we have an opportunity for energy to head higher. You can see here, I do have a trend line right here on energy, or on oil or energy. And if it wants to break out through this area, which I'm just gonna go ahead and set my alert here so I don't miss another opportunity, if it wants to do that for me, then I would love to be a part of it. So right now it's just retesting this area of all-time high of 119. And after it broke through that, made a new all-time high of 123.75, it pulling back and retesting this area would absolutely be beautiful. Absolutely love to see it. So listen, if you guys have any stocks that you want me to go over, so I'm not just sitting here babbling about what I want to hear it. Throw it up in the chat. Let me know if there's any tickers, whether they're big or small caps. It doesn't matter what it is. You let me know and I will do an analysis on it. I'll give you my thoughts on it. You might not like my thoughts on it, but hey, it'll at least be something to go on and ramble other than what I want to hear or say. Let's take a look at a couple of the, oh, that's yucky, yucky, yucky. Let's go ahead and we'll go over while we're waiting for anybody's questions there in the chat. What we'll do is we'll go over, let's just see where I'm sitting at. So NVIDIA's kind of pushing back up. Hopefully it stays under there, and so is UNH. So let's hope it doesn't stop me out for that break even. Good thing I won't be losing any money on stream, right? But what we'll do is we will go over some of these that I've been watching. So some of the stronger stocks that I've been watching currently that were leaders in the market before this pullback, which we would love to see continue, right? We would love to see continue with the overall market, is this wing. This wing is absolutely beautiful. We want to see this thing just continue higher. It's going to be absolutely beautiful if it does. This thing has been on a crazy run. Now, about right here, at this time, I actually went to Wingstop. We just built a new one here in Monroe, Michigan, and I decided to go to Wingstop, and I said, you know what, I'm gonna try this out. I'm gonna give their wings a try, and I'm gonna see if their wings are delicioso and if we should invest. I took the wife there, we got some wings, unimpressed. And I really wish I was, because I probably would have just threw a couple bucks into there, you know, because they were new, and I know that they're popping up everywhere, and they got great financials, right? But no, they were disgusting. I couldn't even get behind it, you know what I mean? But, you know, it was just kind of funny. It was one of those things. It was new. It was fun. But now, knowing where Wing is at, knowing that it is a leader, obviously, we want to see this thing when the market is pulling back, that this volume starts to dry up. We want to see that volume dry up. And it might, as it is already. If that volume starts to dry up, that would be an absolute beautiful thing, because this thing will start to rip tater chip to the north side once again. It looks like it's holding up very well today on this mediocre day, sitting at 366.19. So if you don't already, put Wing on your watch list. We also have APP, another leader in the overall market. This thing had a beautiful cup and handle shape to it before breaking out, holding a 10-day moving average for quite some time, now breaking below its 21, trading at 72.34. APP will always be on my watch list as long as it holds these cumulative gains. MU is in the semiconductors, right? So that's why we are holding this on our watch list. Now, after it had a beautiful gap up on earnings, it pulled back, held most of its gains, and continued higher. Now just trading sideways, sitting at 121.33. We're going to see if MU wants to show its relative strength in this overall downturn of the market. And you guys will see it's very, very clear that the semiconductors are still holding a lot of their gains. So we can see if the market does end up wanting to turn around. Let's say Papa Powell comes out and says, right now, we are cutting rates right now. I can almost guarantee you all of your semiconductors are gonna go rip tater chip to the north side, and you're gonna see it here during the live stream. It's gonna be absolutely beautiful. But if he does that, that would be very surprising. They don't usually do that. They usually, you know, broadcast about how they're going to do stuff. But if he does mention, I guarantee it, if he does mention, we will still be staying our course on 3 rate hikes or 3 rate cuts by the end of the year, I guarantee you we're going to see the market go to the north side. Watch, because people are really pricing in today that we are only going to get 2 or maybe even 1. Some people are still trying to price in that we aren't going to get any rate cuts this year. Okay, so if he says anything about us getting 3, you're going to watch this market start to chirp to the north side. So let's go ahead and look at, no, not QLD, SAIA. So this thing was looking pretty good, but now breaking the 50-day moving average, trading at 55944. I believe this is a trucking company. I'm not 100% sure. Let's go ahead and bring this up just so I don't tell you wrong. SAIA, and I'll just read to you what they are, but they were holding up for quite some time, showing exceptional net margins and net income. So they are a transportation holding company. The firm, through its wholly owned subsidiaries, provides regional and integrational less than truckload, or LTL, services through a single integrated organization. So yeah, they're a trucking company, and they were holding up for quite some time. It's very beautiful to see this company come up, break up on earnings, trade sideways, and hold a 21-day moving average for a while. Then we had this little dip here and then some sideways action, which is a beautiful base to see. It's a slower mover at 2.9%, but we were expecting this, or I should say hopium. We had the hopium that this would head to the north side, but with the overall market and most of your market will be following the S&P 500 and the QQQ. So as that pulls back, you're going to see all that pull back. If you're just joining us, we have the Fed Powell. Papa Powell will be coming out at 1:15. It's going to be a beautiful thing. He is my special guest today, and we'll pass the mic on to Papa Powell. But let's hope, as Predator said, hopefully he doesn't come out smiling because we might see the ball drop. He might drop the mic with a big smile on us, but no, I'm sure he's going to come out and he's going to try and be as dovish as he can today, especially with the geopolitical tension in the Middle East. So we'll see what happens there. Next up on my list is DraftKings. DraftKings has been holding up really well with this relative weakness in the overall market. So we'll see if DraftKings wants to continue hold this 50-day moving average. It's actually making a beautiful trend line here, and it looks like it broke out of that trend a little bit right now. This might be this could go either way. This might be one of the best opportunities to get in. You know, obviously, depending on what Papa Powell has to say, this might be one of the best opportunities to get in, or it might be a great short. But in this situation and the way the market is, I'm looking more at shorting than I am to the long side on any of those pops. Next up is this is Mistress. So I've been watching Mistress for a long time. I got a nice tip from a friend way back here, and they do a lot of I should just bring it up and read it to you, but it's more of a well, you know what? I will just read it to you because I don't want to give you misinformation. So let's look at Mistress here. I'll just read it to you. So I'm in the trades, and they do a lot of this ground penetration, and they do a lot of things where they check the depth and to see how thick certain materials are using radiation. So let me just read this to you. They engage in the provisions of technology-enabled asset protection solutions. The firm is the oil and gas, aerospace, power, infrastructure, and manufacturing markets, and operates in through the different segments, North America, all that good stuff. So primarily of non-constructive testing, non-destructive testing, inspection, mechanical, and engineering services. The international service segment offers services, products, and systems to markets in Europe, Middle East, Africa, Asia, except China and South Korea. So yeah. So this is going to be in your industrial and your energy, right? If they're popping off, they're going to need these guys to come in and take a look at all their products. And we're seeing this in a lot of the oil refineries in my area that I have delved pretty deep down into. So it's holding that 50-day moving average. And if it wants to continue to the north side, that's very, very nice. A buddy of mine told me he was getting in somewhere down here at 467. I still hope, Chip, if you're with us, I still hope you're holding that, baby, because that was a beautiful, beautiful buy. Oh, Gary, what's going on, brother? Hey, favorite, don't tell Sam or Thomas. Yeah, baby, I like to hear that. Hopefully, I think Sam's in here. So, Sam, if you heard that, read it yourself. Read them and weep, baby. Read them and weep. Next up, we'll take a look at NVDA. As you guys know, I took a short on NVDA just a little while ago. I actually can get into this, but I don't want to dwell on it too much. You can see we had a beautiful downtrend here on this 1 minute, just so you guys get a better idea. If my charts stop getting so damn wonky here, we have this 1 minute downtrend. We can see it broke up into this area as it pulled back. My first try was here. I exited some of my position, broke even, but once I seen the 1 minute start to get a little wonky here, I drew my trend line, and this is where I stay. As this comes down, as long as it doesn't break this trend line now, I will stay in this, okay? So that's counter to the way I like to play my trend breakouts to the north side. So currently I am short NVIDIA. Yes, I have the cojones to do it. Because I understand risk management. I will not get anybody the time of day unless you understand risk management, okay? First and foremost, because these are not buy or sell recommendations. The reason why I shorted is because I was expecting a pop. We got the pop. I seen the drop. Now I'm looking for a trend. I found the trend, and now trend is my friend, okay? Once it breaks this trend, I will be exiting out the back door. I'm going to take my money and I'm going to run. So this is the trend, and you can see it's following it very well. And I'm just going to go ahead and move down my stop. So that way, if it does break this trend, I'm out and I'm going to make my money. Currently, we are up an easy $120, guys. And the only other trade that I have on currently is UNH for a short. And you can see it's getting ready. It's getting very close to stopping me out now. We did already take some profits, but we're only up about $40 in this, okay? So this might not be a $500 day today, but you know, just taking small shares, and plus it's an early day. Papa Powell might come out, he might drop that ball, and if he does, I will get my $500 day, which is beautiful. That'll help keep me keep me from going back to the trades another day, right? No, only kidding. It's always nice to have a good job on the side, ladies and gentlemen, so that way you don't depend on your trading, because trading is hard. It's very, very hard to do. And but I tell you, it's a lot of fun, and if you can keep on keeping on with it, you might as well extract as much money as you possibly can from these markets. And when we're in a down path, I look for pops and drops. CRM. Now, you guys seen my CRM trade before. I played a anchored VWAP on this as a short, or I'm sorry, as a long. No, it was as a short, because we had a big pop up into this, and I exited a lot of my position. I'm sorry, a big pull down and a pop up off of that. Carly made it. Good morning. Actually, good afternoon. Drive safe out there. You better not be on your phone while you're driving there, young lady. We hope you make it out there safe. What? Root? We got root, baby. Root's in here. Let's show your roots. Speaking of roots, we're going to have to look at Root and see how Root's doing. Let's do that right now, actually. So Root is a beautiful stock with the overall market pulling back and making new lower lows. We had Root actually holding out on this area. I actually expected this to hold this 21-day moving average and start heading to the north side. I was going to grab a small 15 shares, but the issue there was there was no liquidity. And if we don't have liquidity in the market, we don't want to be in the market. So Root, I hate to say it, but we're still waiting on your stock to do a little finasco to the north side. But right now, we are just going to sit back on the sidelines, wait for this to create something out of nothing, so that way we can make a little bit of money. So if we just want to draw trend lines, we can draw trend lines, right? And we can see and just set an alert here, bada bing, bada boom. And this is not a buy or sell. This is an alert to say, hey, it's time to start watching this again. Is the liquidity coming into this? Is this something that I want to be a part of? And if it is, so be it. I will get in, but I need to see this liquidity come in. What do I mean by liquidity? Well, if we look down here, see how high this volume is? This volume down here is a sure sign that if a bunch of people are buying this up, you want to be just behind or with these guys, right? You don't want to be buying in up here, because this is where they are selling. This is volume. This is when people are buying and selling equities, or this share. This is where you are going to see this all happen. Okay, there we go. We just stopped out of NVIDIA. Let's go ahead and take a little peek at NVIDIA and see where we are ending up. So it looks like NVIDIA just started to break above that. Let's look on the 1 minute, because that's where I took it. We just broke above that. Now, this might be a little psych out, so I might end up getting back into this, but let's see. So we have NVIDIA here. It did break out above this. So I set my stop, and boom, we made a quick $70 on this, guys. So within an hour, I made a quick $70, and it's just using these trend lines. Now that it's breaking this trend line and it looks like it wants to head up to the north side, we can bring up that same issue I told you earlier about. Look at this. We have some volume coming in here. We did a nice dry up in volume on the way down, and I'll just enlarge this so you guys can see it. A nice dry up in volume, and now we're getting a push in volume to the north side. Now, I've already told myself, and I cannot go counter trend now, but if the market wants to push higher, that's fine and dandy. Let it go, but I am looking to short this market, okay? And if I'm wrong, that's fine. I won't lose any money in it, right? If I'm wrong and it wants to continue to the north side and we don't see any pullbacks, I won't be in it, okay? Let's go take a look at UNH to see where we're at. It looks like UNH did not break. It did not stop out. So maybe we continue to head back down to the north side. We're up about $70 currently in total on this stock, and we'll see if it wants to continue down to the south side. Now, why did I take UNH? Well, look at the pre-market. This thing gapped up over 7% in the pre-market, okay? Now, it was on good earnings, but if you look at the overall ETF and this overall, we can see this is a stage 3, okay? What is a stage 3? Well, if we study Stan Weinstein's stage analysis, you'll see that stage 1 is a base, stage 2 is the uptrend, stage 3 is the sideways trend. Now, I want to be in the stage 4 where it comes back down. So that's what I'm trying to get in, a small piece of that stage 4. So is this the right timing? Well, we got a big push up here. I'd rather be in up here than down here trying to play the stage 4. So we are in up here. We took a small share size. We cut a little bit. We made a little bit of money on it. And now we're just going to hold. Let's see here. we got AMD. So AMD is weaker in the overall grouping of the semiconductors, guys. This is broken down long before anybody asked it to, breaking below a 50-day moving average before we even had Bloody Thursday last Thursday, as Dan Bob likes to call it. Thursday, Bloody Thursday, this AMD was already below a 50-day moving average. So that's not a good sign for AMD, especially in these markets. So if we are going to continue to head down and we're going to continue to pull back, you better believe AMD is going to be leading the charge to the south side since it was already there. And we will go over a few other stocks as well where we're here that look like they had turned to the south side before the market had even done that. ANET. ANET was a leader in this overall market. I believe ANET is a software company, but we can read about ANET really quick. So we'll just bring up ANET and let me read you about ANET. Now they have great financials. They have a great net margin. This thing has been going to the north side. So why is it pulling back? Well, it's not about the financials, ladies and gentlemen. It never is about the financials. That only helps. It's all about what the market has already priced this in. So it's all about those technicals, right? It's all about that base. Well, it's all about the technicals. And the Arista Networks, Arista Networks, engages in the business of developing, marketing, and selling cloud networking solutions. The firm is also involved in switching and routing platforms and related networking applications. The company was founded by Andreas, I can't say that name, Bechtolsheim, I think it's pretty good, and David Sheraton and Kenneth Nuda in November 2024. Excuse me, and is headquarters in Santa Clara, California. There's a lot of startups out there in California. So that's ANET. ANET is in the software, the cloud computing, and this thing had a big pullback, another one below its 50-day moving average. Nothing is looking good out there. And a friend turned me onto this. This was really cool. If you guys want to take a look at this, let me just go ahead and bring this up. Give me 1 second. The MMFI. So this gives you an example. Okay, this is not a stock. Okay, it looks really wonky, right? But what this is it shows how many stocks or how many companies are above their 50-day moving average and how many are below their 50-day moving average, okay? So this shows that most are below that 50-day moving average. 50-day being right here, we are on a big downtrend to the south side. So even if certain stocks look like they're doing well, you can see in the overall market that we are below 50-day moving average. Half of the stocks that are out there are below, right? They are downtrending. They're below their 50-day. So percentage of stocks above their 50-day moving average, this is the 50-day. If it's above, then we're above. Right now, only 32% of stocks are there. So we are below. We are downtrending. Things are not looking good for the overall market. So even if you find a good stock, if you find something healthy, you can expect it to have a pullback or at least continue with the overall market. So be very careful out there. Don't get too sidetracked on what is going on in the overall market or very select stocks. ALLY, this is another stock that I was looking at for continuation of the north side. We made a little bit of money off that during the bull market. Let's see, Taiwan Semiconductor. This is the whole reason why I bring it up, guys. When you get these pops like this, don't get too excited. I have a feeling these pops are going to be short-lived. Speaking of short-lived, let's see if NVIDIA held on too much of that pop. And look at right here, guys. Right here, you can see that it's starting to pull back already, fighting this area, popping back up. This might be a nice area to risk. Maybe I go ahead, I got a little money here, a little winner's money here to play this. Maybe we play to the top of this, but breaking this trend here to the north side and then bouncing off of it, continuing higher. I mean, I hope for the sake of everyone holding NVIDIA in your long-term accounts that this does go higher. I want to see NVIDIA go higher, and this would be a beautiful push to the north side off of this retest. So let's hope it can for the longer-term accounts. That would be absolutely beautiful. So good luck, NVIDIA, and good luck to anybody who is in that, who played that trend. It's absolutely beautiful. I'll take my money and run. Let's go ahead and head back over here. BTC, oh goodness gracious. So be very careful in these. This is a Bitcoin strategy. This thing is not very volatile at all. RVSN, man, the reason why I don't stop looking at RVSN, and I'll tell you exactly why. This is exactly what I'm looking for on an hourly trend break. Right here, guys. Now this is a very small cap, very fast mover. And guys, if you're just joining us, please keep in mind, old Papa Powell, my special guest, Jerome Powell, will be out. He will be out very, very soon at 1:15. He'll be speaking from 1:15 till 2:15. So we only have a few minutes left, and he will be out speaking with us. So for now, we're just going over the market. We're going over some of my trades. We're going over how I trade. We're going over some of the news. We're going over the Fed rate hike decisions, and a little bit of that data is coming out. So if you haven't already, make sure you hit that like, hit that subscribe, guys. Really appreciate everybody being here. Let's go ahead and see if we can bring up the live stream just yet, because sometimes they'll let it out. Let's see here. Yeah, sometimes they'll release it a little early so you can wait in the lobby, but they have not released it yet. Don't worry, I'm going to stay up to date on all of that just for you, so that way we can be first in that room. We want to make sure we are first, as always, ladies and gentlemen. And there's one last thing I'm going to do before we jump right back into it. Let's go ahead and do one of these. All right, guys, so if you haven't already, I just want you to look at my screen. We want to make sure everybody stays up to date, but if you haven't already, take a look at my screen right here, and what I want you to do is I want you to go ahead and smack this like button right here for me. Smack that like button. Let's go ahead and try and get up to 15 likes today. One other thing I want you to do, if you haven't hit this subscribe button yet, I'm here all the time giving you the best data, the best analysis. I trade for you live. I do everything that I can, and I give you bite-sized data, the PPI, the CPI. I give you all that data. So hit that subscribe button. I appreciate you being here, and we'll get right back into it. But that I have to do, guys. You got to do that. That is self-preservation there. So thank you so much for being here. Make sure you hit that like and subscribe. So next up is this RVSN. This is what I look for on those hourlies, guys. On the hourly, we can see we have these hourly trends, right? And why am I looking at it on the hourly rather than the daily like usual? Because this is a very fast mover. At one point in time, I think this was moving at 20% a day. This only moves 14.4% now, but you can see we have backed way off on this overall market. Now, this had 3 trend breaks to the north side, absolutely beautiful, and I wanted to be a part of these, but it was not part of my criteria when I seen RVSN. So now I'm continually looking at these faster moving stocks. Like today we have on the gap up scan. And again, guys, these aren't buy or sell recommendations. These are very fast moving stocks. These can make or break your account. So when we have something like WISA and it sets up after a big push like that, if it can pull back and create one of those trends like RVSN, then we can play it. But we have to wait for these to set up and make clean breaks to the north side on higher volume. And you can see it did that each and every time, heading all the way up to 2212. So this trend break could have earned you up to 300% on your account playing this. Now, I was even watching this one back here for a trend break, and we just didn't get it. We didn't get the volume either, which is great. That means it's going to head back down to the south side, as it did. Next up, ARDX. This is a beautiful one that I was keeping an eye on as well. I just wanted to keep orienting myself. We always want to save our stocks that we're keeping an eye on so we can look back to see how they're trading now. And you can see right here, this was a beautiful trend down here at the base that I was keeping an eye on. Did I get a piece of this? Well, it looks like I did. I played it down here and got that trend break at 374. I would have to go back and look at my trader journal to see exactly how much I extrapolated from that, but from what it looks like, I would have been stopped out at 433. So about $1 on that overall trade, but not for the lighthearted. RDNT, this is just one that's trying to hold its 30-day moving average. You can see with the overall market pulling back, this is why we go through these stocks, guys, because we want to know exactly where we are at in the overall market, and if we can find these stocks that are trying to hold above that area. Those are those stocks that are trying to stay above water while the overall market is trying to make a correction, then we might be setting ourselves up for a future trade. Now, I want to go back over the overall market before we get too deep into this, because old Papa Powell will be coming out in about 25 minutes here, and it looks like we're just trading sideways. That's pretty usual when the old man's going to come out and start japping his jaws. We usually have a sideways day, and after a huge pullback, like we talked about earlier, after a huge pullback like this, there's a lot of uncertainty in this market. When there's a lot of uncertainty in the market, we can expect some sideways action, or usually at least a bounce before we start to head lower. And in this situation, we are just trading sideways. So that is pretty usual for a Papa Powell speech before we start. And it's not very typical for a Monday. Actually, today's Tuesday. It's not very typical for a Monday either, right? To trade sideways, because we have all that data to ingest on your Mondays. So let's go ahead and look at a few more stocks. TRML, I can go ahead and take that off my watch list. That thing is beaten down and broken. But CELH, this was a very interesting one up here at these highs. It's very unfortunate that I relinquished my short trade on this, because goodness gracious, I could have made a lot more stinking money on this thing shorting this to the south side. But hey, it is what it is, and I'm happy that we could make at least a little bit of money on this. But as traders get better, and I've noticed this from a lot of the books that I've read, they all start off scalping. They start taking very small amounts and abstracting small amounts out of the market. And then eventually everybody starts to learn that the wider the stop and the higher the bill, the longer they like to stay in those markets, the longer they like to swing trade into those markets. So a lot of times you'll see day traders or scalpers sometimes turn into day traders, turn into swing traders, okay? And because that's where the big money's at. So all of these like Kel O'Neill, Chris Quilamage, Mark Minervini, William O'Neill, all these guys, they're swing traders, and there's a big reason for that, and why aren't they investors? Well, because investors just buy and they always hold. So their money's gonna constantly fluctuate. Where if you're a swing trader, your money's gonna swing, but you can tell whether or not you're doing the right thing by, if you're not making money, you're not doing something right. It's pretty simple. So today, yes, I did a little day trading today, but we're in a market where it's hard to find these swings. It's hard to get a hold of these, right? So what do? Eventually, over time, you start to hold these things for a little bit longer. You know where your buy and sell, where your support, your resistance, where your supply and demand is. And that's exactly what we do. Now, CELH, we made a little money on this short side, but we could have made a lot more. So we're going to learn from it, because remember, you're a loser unless you're learning, okay? So let's make sure we learn from everything that we do. Whether you are winning or you are losing money, there's always a way to learn and extrapolate a little bit of knowledge from that. Now, ACMR, this is actually still holding up pretty well in this overall market. You can see the downtrend that I was trying to play here. We did not get that. It broke above it, and it stopped me out for a very small loss on this. Now, when you're playing breakouts, your average win percentage is usually only about 40%, and that's why you want to have a bigger risk multiple than you do a loss multiple. So if I'm winning 10R each trade and I'm losing 1R each trade, that means I'm getting a 1 to 10 risk reward. Now, that's a little blown out of proportion there, guys, but I will say, as long as you're getting that 2 to 5R, you're going to be making money even with a 40% win rate. And if you don't understand that, we are actually building a free course, so we can send that out to everybody, and we can refer them to our free trading course very, very soon. That is in the making. So I appreciate you being here with me. And if you don't get it or you have any questions, just throw it in the chat and I'll be happy to go over it. Now, ARM. If you guys don't remember ARM, or you don't have this on your watch list, I suggest you putting it on here now. It is in the semiconductors, and we have said multiple times, semiconductors have been holding up the market. They are the ones that were there for the bull run during AI. They were moving up before AI became a thing, and they are holding up now. So they have had a pullback, yes, but they are holding up relative to the overall market. So ARM is looking very strong in these areas. Now let's go back and look at the market, because we're getting closer and closer to the to the Jerome Powell speech. We have about 15 to 18 minutes before that comes out. So let me take a sip. Now that's some go-go juice, baby. That's some go-go juice. All right, so the S&P 500 still just trading sideways. Let's look at the QQQ, the overall tech-heavy giant, still trading sideways as well. We're in a range between 432 and 429, currently trading at 431.78, smack dab in the middle, and we don't like to diddle in the middle, as I like to say on one of my favorite shows. Let's go ahead and look at coin. So coin, what a huge pullback here, guys. And why is coin pulling back? Well, we can base that off of Bitcoin. If Bitcoin pulls back, coin is going to pull back. It follows Bitcoin pretty well, not to a T, but with the halving coming up, you're going to see this become a very volatile market for anything related Bitcoin. I like to keep AI on here just because this was a fun one. I did multiple videos and made multiple trades on this. Absolutely beautiful stock, pulling back to 2077. And guys, when I say a beautiful stock, I don't mean something to invest in. I'm saying a beautiful mover, something that has a lot of liquidity, something that we can trade on a daily and a swing basis, okay? So keep that in mind. If I say it's beautiful, it's because it's the chart, not the company. Dell. So why do we have Dell on here? Dell actually is showing a lot of strength. This is a very old technology company, but with technology doing its thing, this is actually forming another trend here. So this is something I'm gonna wanna watch. Now, it is a faster mover than it used to be. This thing is moving 4.5% for it being such a big boat of a stock. Let's actually look up Dell because I am very unaware that it was this fast of a mover. At an $85.3 billion market cap, this thing is moving like a mid cap. Absolutely beautiful to see a big boat like this. So this has a lot to do, I'm sure, with the chips. It has a lot to do with AI, has a lot to do with technology and computing. So when you see something like this, well above its 50-day moving average still, above its 30 and its 21-day moving average, this is still a great sign for the overall stock itself. So I'm gonna go ahead and set an alert here. So next time Dell gets above this area, which it might even do today, you never know what's gonna happen in these markets. That's why it's just such an honor to be here. I'm blessed to be able to do these shows because I get to do what I love. I get to be in front of the market. I get to speculate for you, and we get to share ideas. As PSTG just still trading sideways. This is a pure storage play. Back here we had this downtrend. I was waiting for it to rip tater chip to the north side and it didn't do much at all. We have 15 minutes till Powell comes out. I'm just going to take a little peeky gander to see if they are going to launch this just yet. They have not launched it yet, guys, but don't you worry. I have the virtual Washington Foreman on the Canadian economy coming up very, very soon at the Wilson Center. So the old Powell, I've registered for Tuesday, April 16th, 2024 at 1:15 to 2:15. It will be streamed live on their website. So I will have that up so we all can take a little peeky gander. We can all listen in what old Powell has to say. Mic is working, mic is hot. We got the music on, and I will need a reminder to kill the music once old Powell gets turned on here, but enough of that being said, let's go ahead and move on. CRSP, so CRISP, that is a biotech stock. I remember when people were getting real talkative about this, you know, CRISP, the CRISP technology and stuff. Nothing right now. TRIP, I remember when this thing was getting very, very exciting. We have a trend break right here. This would have been a nice little catch to make. I didn't actually play it because there wasn't enough volume in the morning to take this breakout. It was actually the next day to take this breakout, and we would have gotten out half of our shares and then gotten stopped out at break even for the rest of this. So it would have been a nice little catch. A nice little pocket of money right there. LRCX just trading sideways, creating this base, now breaking down, trying to bounce off that 50-day moving average. VKTX, you guys remember VKTX? This was really exciting. A lot of people were playing VKTX. I have a couple of friends that were making some money on this. Another trend breakout to the north side, absolutely beautiful. Now trading still above the 50-day moving average, but it doesn't look like we are getting too much. We aren't getting too much action here from VKTX because the overall healthcare industry is pulling back. The bio stocks are all pulling back. Everything's pulling back except for the semiconductors, and even they are having a hard time holding on to a lot of their gains. Speaking of which, let's go ahead and look into some of my favorite stocks like NVIDIA, NVDA. So let's go ahead and zoom in on the 5-minute to see how it's doing. Yeah, it's still holding out. And this is, guys, this is exactly why I have stop losses, right? So as I got in here and I played this all the way down, we held on to that until it broke this trend. Because if I was still holding on to this after it broke its trend, I would be stopped out for break even. Instead of making that quick $80 in an hour, I could have lost money, or I could have broke even on this play. So when I see a change in trend, I'm out. I get out, I wash my hands clean of it. We like to make money quick. We like to make easy money here. We don't want any stress. So we make sure we use risk management and we do it properly while we are trading. So thank you guys. Thank you guys. Let's see what else. All right, guys, so let's go ahead and look at some of these quicker movers. LGVN, I've been waiting for this thing to set up. I thought for sure yesterday I was going to be able to catch a piece of this, creating the same type of trend. I mean, I almost can just grab this here and bring it right on over here. See that? And then when it breaks its trend, I actually got into this trade yesterday, but a lot of the guys in the Discord know when I play these quicker plays, so this moves 28.2%. When I play these quicker plays, I get very impatient. So I use this stop at the base at 239 as my stop. It popped up, it pulled back, it traded sideways. I exited this position. If I would have just held, sure, by the end of the day, I could have made a couple $100, but I stopped out for break even on this trade. I wasn't gonna sit here and play around. When I get in something, I expect it to do exactly what I expect it to do, and if it doesn't, I'm out. I'm out of it, right? So that's exactly what happened here. But it's okay. I'm happy to take home break even rather than take a loss on a trade, so I should just be grateful. But LVGN, or LGVN, excuse me, I'm waiting for it to set up again. Show me another trend, show me another break to the side, upside, and I will be back into play it. But these are not for the faint of heart because they are very fast movers. AUUD is just doing its thing. It doesn't look very good. BSGM, not so good. MCBC just kind of popped up and is holding out there. PALI, if it can hold some of these gains, it might be a tradable equity for tomorrow for a day trade. And WISA, now this thing really ramped up. It's currently trading 284% higher than its than what it opened up at this morning. Now this thing is a gap and crapper, and you can see multiple times it's done this. So for it to actually continue would be very rare, but I will say this, if it piles in a lot of shorts in this area, what we can expect to see is the shorts get piled in, and then if it creates a trend and breaks to the north side, you're gonna see a lot of those covers start to pile in again. And if they start to pile in, we might get a nice squeeze out of this. So I'm gonna take WISA and I'm gonna put this on my faster movers stock watch list. And that's all I'm gonna go over when it comes to the small cap gappers, unless you guys have any questions or anything that you wanna point out, just because I try to stay away from these, especially with the, I mean, I don't mind trading them, but I don't like preaching about them because then it gets a lot of newer traders kind of stuck and involved in these small cap stocks, and it can ruin your account. It can make or break your account, and we don't want anybody getting hurt on this channel, so please be careful with all that. Now, let's go ahead and we'll go back over the quick market here, and then we'll check old Papa Powell, see if he's ready for us yet. S&P 500, it looks like it's doing a nice little pullback here. Yeah, it's created this top here at 505.25, and now it's pulling back, just still trading sideways here. Let's go ahead and look at the Russell. We haven't looked at the IWM in a while. Now the Russell had a nice little pop this morning. It looks like it's creating. It's right where it closed at yesterday, and now it's showing that area as resistance. But man, it sucks to see the Russell down here. I was really hoping and expecting the Russell to continue higher. I was waiting for it to act as a lagger with the overall markets starting to head higher and the IWM just trading sideways. I was waiting for the IWM to just boom, pop off, start taking off like crazy, and then you'd see all these small cap and mid cap stocks setting up beautifully. Like that's what I wanted. I wanted to have all these faster moving stocks to set up and head to the north side. So guys, if you're just joining us, be very, very attentive, be very alert. We have Jerome Powell coming out here in about 8 minutes. About 8 minutes. I'm going to check to see if they actually have this up yet. It doesn't look like, I don't see them. They have not started to stream it just yet, but I will be first. We will be first, and this is directly off the website, guys. I signed up. I did an RSVP for the event, so that way you will get it here first and fast and now. You were gonna get it right away, guys, because we signed up for this first. Not because we signed up for it first, but because we signed up for it. We're not going off of somebody else's YouTube where they're getting it 4 seconds later and you're getting it 4 seconds later. We're getting this straight from the tap. So your mouths will be thirsty. We're gonna feed you out. We're gonna water you. I don't know where I was going with that analogy, but let's just roll with the punches here, baby. So IWM is still just trading sideways. It did have this pop up in a previous day's close. We're gonna see if it wants to hold out there, but I think everybody's waiting the exact same thing that we're waiting for, guys, and that's the old Papa Powell, the speech to come out and start chatting. Let me get a sip here. Listen to that lo-fi music for a minute. Oh yeah, not much longer, guys. About 7 minutes till my guest speaker comes out. Oh, Papa Powell, ladies and gentlemen. You said it will go up, Tyler? What's gonna go up? The market? The IWM? My ratings? Either way, that all sounds good to me. Root? Maybe Root will go up? Oh, water that. Got to, man. When you talk a mile a minute, you need a little something to wet your whistle. Isn't that for sure? All right. We're just going to go ahead and refresh this to see if this event is going to pop up for me or not. Let's go. I want to see old Papa Powell's beautiful gray hair. I'm trying to look more like him. You know, he's got a little bit more grays than I do, but you know, his wisdom shining through there. Mine not so much. What up, B. Stewie? Tell me, B. Stewie, am I in the nerve center or not? Am I in the nerve center? I hope you got me on the big screen, baby. How you doing, B. Stewie? It's good to see you. I'm glad you're here. I'm glad you could make it. Old Papa Powell is going to be hopping on here in about 11 minutes. I'm just making sure that we have everything ready to go for him. We want to make sure that we are first here for you guys and that we are going to get the second they launch. It looks like, there we go. Can I click on it? Can I click on it? Come on, let's go. Let's go, baby, come on. Oh, here we go. All right, I'm gonna bring it up for you guys right now. It says that it's starting soon. So let's go ahead and get everything situated for you. Let me go ahead and do this. We'll start by doing this. We get rid of this. Almost done, guys. Hold on to your butt cheeks. We're almost done. We're gonna have a good time today. We're gonna have a good time with this. All right, so while this is going on, we wanna make sure everybody's happy with the broadcast, with the stream, with everything that's happening. So make sure if you have anything that you guys want to talk about or anything that's going on, anything specifically, what I usually do is I have the S&P 500 up here, and I'll usually leave this on a 1 minute so we can exactly see. What I like to do is, like, if old Papa Powell says something like, you know, we're going to war, he wouldn't say that, but you know, if he said something absurd like that, or if he said something like, we are going to cut rates today, you know, I want to see this right here on the S&P 500 to see exactly how the overall market and how it reacts to this. Okay, so that being said, I like to keep the S&P 500 up to see exactly how it trades, right? So that's what I'm going to keep up unless you guys have something that you want to watch. Then yeah, so drop by to give you the, hey, Pawn, my man. Thanks, brother. I do appreciate you stopping by. Pawn's a good friend. He's from the Beginner Trader. John from Beginner Trader. If you guys haven't already, go like and subscribe to his channel. He's given me plenty of shout outs. And he is the man. John is the man. I do appreciate him. And Pawn is over there and helping him out with his channel. And so I do appreciate you guys. Okay, here we go. It looks like they are getting ready to start here.
Woodrow Wilson International Center for Scholars, and welcome to the launch of the Washington Forum on the Canadian.
All right.
My name is Xavier Delgado.
I'm going to go ahead and keep my mouth shut. You guys enjoy the stream.
Here with the Center's Canada Institute. Now, our CEO, Ambassador Mark Green, likes to say that we are congressionally chartered, scholarship-driven, and fiercely nonpartisan. But I tack on a fourth attribute to that. We are one of the few think tanks in the United States that has a program dedicated entirely to the study of Canada and the US-Canada relationship. And now today, with the launch of the forum, I'm proud to say that we are one of the only think tanks in Washington, in the nation's capital, with a sustained initiative on the expansive Canada-US economic relationship. And we are so pleased that all of you are here today in the room and online to join us in celebrating the start of this special initiative. Now, we have a great program. I won't get in front of the men on stage here. So to kick things off, I'd like to introduce someone who can tell you a little bit more about the forum. He is the former vice chair of the Federal Reserve Board for Supervision, former Undersecretary for Domestic Finance at the Department of Treasury, and the current co-chair of the Washington Forum. Ladies and gentlemen, please welcome Mr. Randy Quarles.
Thank you. Thanks, Avi. Thanks, everyone, for being here today at the Wilson Center's Canada Institute, both in person and through the miracle of the internet. Today's the opening event of the Canada Institute's Washington Forum on the Canadian economy, as Avi said, and the objective of the forum is to educate U.S. policymakers and business leaders and the public on the dynamics of the Canadian economy and on the importance of our two countries' close economic relationship. Countries, like people, accomplish the most when they set clear priorities based on data. And any dispassionate review of the data shows that one of the very highest economic priorities for the United States has to be our relationship with Canada. Now, a lot of the discussion about the U.S.-Canada relationship tends to focus on its importance for Canada. Trudeau the Elder's famous comment about sleeping with an elephant.
What?
But Canada is our largest export market. Almost 20% of everything that we in the United States send abroad into this world of 8 billion people goes to the 40 million people in Canada, who are only 1/2 of 1% of the world. It is the largest and most comprehensive two-way economic relationship among any two countries in the world. The evolution of the energy economy of global importance will be heavily influenced, perhaps determined, by decisions that our two energy-producing nations make. We have a unique role in being advanced financial economies, using a lot of energy, but also significant energy producers, and can balance the effects on economy and society of the choices that we make. And on top of that, Canada is a key U.S. ally in the international financial architecture. I've spent 3 different tours of duty in government service, where a big chunk of my job was international financial diplomacy, and we could always count on the Canadians being sane, solid, and punching way above their weight. And yet the U.S. tends to take it for granted. And my experience in life is that the good things we take for granted, we tend to mess up. So my hope is that with this series of events, we can be part of helping focus folks in the United States on the importance to the U.S. of this relationship by finding speakers and topics that will have a very broad appeal beyond the usual suspects who focus on our relationship with Canada. And we certainly have that with our event today, which includes 3 of the most significant economic leaders of our two countries. Bill Morneau, our moderator today, is, well, when you look in Wikipedia under Renaissance Man, there is an inset photo of Bill Morneau and nobody else. Recognizing his significant achievements across politics and policy and business and philanthropy, he's the former finance minister of Canada, playing a key role in shaping sustainable economic policies of the Trudeau administration, including Canada's economic response to COVID-19, and a key reason for Canada's aforementioned above-weight punching in international diplomacy. As a business leader, he grew the multinational human resources firm Morneau Chapnell from a family business to over 4,000 employees and the largest human resources provider in Canada. As a philanthropist, he's worked to support the arts, help at-risk youth, improve access to health care and education all around the world, including founding a school for Somali and Sudanese girls in a UN refugee camp in Kenya. And as a policy thinker, in addition to his role chairing this Washington Forum, he's chaired the C.D. Howe Institute, a leading Canadian think tank, and has written Where to From Here, a policy book that it is several cuts above the typical former official's post-service book. I put it up there with Robert Rubin's In an Uncertain World. Anyone who has ever served in any government of any country at any level at any time will immediately recognize the honesty and intelligence and savvy that he's brought to thinking about the lessons of his time in office for the issues facing Canada. And all of us, I highly urge all of you to read it. Tiff Macklem is the governor of the Bank of Canada, and another of the reasons for Canada's substantial above-weight punching in the world. In addition to his role as governor, he's the chair of the group of governors and heads of bank supervision. That's the oversight body of the Basel Committee, rather high profile these days, and he is co-chair of the Financial Stability Board's regional consultative group for the Americas. He's a distinguished economist, having headed the most important division of the bank's economic staff in the early 2000s, having played a critical role in Canada's response to the great financial crisis in his post in the Canadian finance ministry in the mid-2000s. He's been a senior deputy governor of the bank from 2010 until his appointment as governor. He's also been a distinguished academic, having served as dean of the Rotman School of Management at the University of Toronto. And our final panelist is Jerome Powell,
That's right.
chair of the Board of Governors of the Federal Reserve System.
Powell.
It is a weird task to introduce Chair Powell. It's like introducing Henry Kissinger. How do you do it without looking absurd? His doctoral thesis on Metternich received very high marks. So just let me say this. There is an anteroom off the main boardroom in the Eccles building, which is the Fed's true headquarters building. They're currently slumming it in an annex, where the portraits of all the Fed's chairmen hang. And as you look around them, it is borne in on you that none of them will have been as consequential across as broad a range of matters as Jerome Hayden Powell in managing the remarkably low inflation and high employment of the pre-COVID period, in the world historical response to both nationally and globally to the COVID event, in the first major review and
guys, we have a poll up. Go ahead and vote on the poll now. I'd like to see what everybody thinks is going to happen with old Papa Powell dropping the mic. So in the chat, go ahead. There's a poll up. Go ahead and interact with that poll. Let me know what you guys think.
But hydra-headed body that is the Federal Open Market Committee. So let me thank you again for coming, and let's turn to our panel.
Well, I want to start by thanking you, Randy, for that very, very generous set of introductions, and also for your willingness to step forward as the co-chair of the Washington Forum on the Canadian Economy. So we very much appreciate your esteemed leadership, and one of the key reasons we're here today is due to that. So really appreciate it. I'll just say personally, one of the things I like most is you said Canadians were sane. So that's a pretty good starting point, I think, for our discussion here today. So with two esteemed panelists, I won't really be speaking much. I want to give both of you gentlemen an opportunity to talk a little bit about your respective economies, and I guess also recognize that we're here to talk about the Canada-US relationship and what is both distinct and different about our economies, but also what we share. So maybe with that, I could start with you, Governor Macklem, and then we'll talk to Chair Powell.
Well, thanks, Bill, and I think you better call me Tiff. It is a pleasure to be here, and thank you and Randy for launching this, for inviting us both. I am very pleased to be here to say a few words about the Canadian experience, and I always enjoy comparing notes with Chairman Powell. Now, as Canadians, we invariably compare ourselves to Americans, and maybe it's human nature, but we tend to focus on the differences. We've got different systems of government. We're bilingual in Canada. We have 3-down football, and we even have very colorful polymer banknotes. And certainly our climates, I think, are certainly the IMF meetings are always a welcome first blast of spring for the Canadians. Our economies obviously have much in common, but again, we often focus on the differences. If you look at growth in Canada and the United States over the 20 years leading up to COVID, remarkably, the average was exactly the same, average 2.2% in both countries. The sources of growth, though, have been a bit different. In Canada, we've grown more by adding workers. Our participation rate has risen more, and we've had proportionally higher rates of immigration. In the United States, adding workers has also been important, but increasing output per worker, or productivity, has made a relatively larger contribution. And I will admit, in Canada, we look at U.S. productivity growth with some envy. And we do ask ourselves, I mean, what can we learn from the U.S. experience? We are concerned about productivity growth in our country. Turning to the financial system, we both have strong banking systems, but the structure of our banking systems is quite different. In the United States, you've got a lot more banks than we do in Canada. In Canada, we have five large national banks and a number of important regional players. The structure of our mortgage market is also somewhat different. In Canada, the typical mortgage is 5 years. In the U.S., typical mortgage has a term of 30 years. And our banks in Canada tend to hold mortgages on their balance sheets. U.S. banks securitize a lot of their mortgages. Despite these differences, our systems are very integrated, and indeed, a number of large Canadian banks have large operations here in the United States. Our pandemic responses were also mixes of similarities and differences. Broadly speaking, the paths of our two economies were pretty similar. We both cut interest rates very dramatically to effectively zero to support the economy through the pandemic. Then we both raised them very forcefully as inflation rose rapidly, and we've both seen inflation come a long way back. Growth has been more resilient in the United States, though, through this tightening cycle, and I think that's partly related to the stronger productivity growth I mentioned in the United States. And it may also be related to the fact that monetary policy may be having a bigger impact on households in Canada because of the different structure of our mortgage market. More of our mortgages have reset in Canada, so more people are feeling those higher interest rates.
This is your current inflation rates, guys.
That has restrained household spending more in Canada.
Right here.
In each of our countries, I do want to underline that we gear our policy decisions to our domestic monetary policy mandates. And in Canada, we have our own currency, we have a flexible exchange rate, so we can run our own monetary policy. So simply put, we don't have to do what the Fed does. We can do what Canada needs. I do think, though, we're looking at the same things and asking ourselves the same questions. I think we both need to feel confident that we're clearly back on a path to 2% before it would be appropriate to reduce interest rates. Last week in Canada, we held our policy rate at 5%, where it's been since last summer. We did stress that we are encouraged by the recent progress we've seen on inflation, and we want to see it sustained. And just this morning, Statistics Canada published the March CPI. As expected, headline inflation came in close to 3%. We have seen gas prices in both our countries move up. Importantly, though, measures of core inflation did tick down again, and that does suggest that underlying inflationary pressures are continuing to ease. So we continue to be moving in the right direction. The other thing I want to underline is that in the conduct of monetary policy, we do spend a lot of time looking and understanding what is going on in the United States. U.S. economy has a very big impact on the Canadian economy. We also watch the U.S. economy closely, particularly through the extraordinary period we've all been through in the last few years, because the more we understand what we have in common and our differences, the better we can learn from each other's experience. And let me just close on a few words on just how integrated the Canadian-U.S. economy is. And Randy, you highlighted some of the key facts. I would totally share your perspective. I think the economic relationship really is the model for mutually beneficial open trade and investment. 77% of Canadian exports flow to the United States. And as you underlined, what less people know is that Canada is the United States' biggest export market. 17%, or as you said, almost 20% of U.S. goods head north to Canada. If you look at foreign direct investment, there's a similar two-way dynamic. In 2022, more than half of Canadian FDI went to the United States by far the largest share of our FDI. That was roughly $43 billion. In the same year, $50 billion of U.S. FDI came to Canada. So it's a pretty balanced relationship. And I think what these numbers underline is just how close that economic relationship is and how it works in both directions. And the final thing I'll say is, when you look forward, we face many of the same structural challenges. Our labor forces are aging. There's going to be a big challenge with new technology, training, and making sure we have the skilled workers our economies needs. Climate change is affecting both our economies. We're both grappling with shifting trade and investment patterns globally. Supply chains across both our countries need to build more resilience. Conflicts internationally are increasing global uncertainty. And for all these reasons, I am very glad we're having this discussion. We do have much in common. And Randy, as you underlined, when we work together, we can get a lot more done. Thank you.
Well, thanks. That's a great place to start. Chairman Powell, really interested in hearing your perspective.
Another place to start is to say, why don't you call me Jay and call Tiff?
Okay, I know I do it behind the scenes. I'll do it in front of the scenes.
Great. So let me start by...
We're going to start calling him Jay
Randy
now.
And Bill and Javi and Tiff for this. It's great to be here today. I want to echo what Randy said about the mutually beneficial, respectful, great relationship we have with Canada, economically, culturally, and I'd also like to echo, I thought Tiff did a great job talking about the similarities and differences.
Markets going up.
In our economy, our financial markets, the challenges we face in our policy stance. It's almost as though you somehow had a copy of that part of my remarks, Tiff. So I'm not going to repeat that, but what I will do is talk, if I could, a little bit about the U.S. economy and where we find ourselves right now. So as I think Randy pointed out, the performance of the U.S. economy over the past year has really been quite strong. We had growth of more than 3% last year as rebounding supply supported both robust growth and in spending and also employment, alongside a considerable decline in inflation. The more recent data show solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal. So I'll say a little bit about our two mandate goals, maximum employment and price stability. As I mentioned, the labor market remains very strong. Payroll job gains have been strong over the first quarter, averaging just a tick above 275,000 per month. The unemployment rate has been below 4% for 26 consecutive months, which hasn't happened in more than a half a century. The longest
Market's headed right back down.
Strong demand for workers has been met by a substantial increase in the workforce due both to rising labor force participation and a substantial increase in immigration, as indeed Canada has experienced as well. So even by
volume coming in the market,
strength, by many measures, our labor market has been moving into better balance over the past year. The ratio of job openings to unemployed workers was extremely elevated in 2021 and 22, has now moved back down to levels just above the pre-pandemic era. Surveys of workers and businesses indicate a normalizing labor market. So do the rates of both quits and hires, and broader wage pressures also continue to moderate, albeit gradually. So the overall picture for the labor market is one of real strength, but gradual normalization. Turning to price stability, our inflation mandate. Inflation, of course, declined quite significantly over the second half of last year, over the whole year, but particularly in the second half. But 12-month core PCE inflation, which is one of the most important things we look at, is estimated to have been little changed in March over February at 2.8%, and the 3- and 6-month measures of inflation are actually above that level. So we've said at the FOMC that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. You know, we took that cautious approach and sought that greater confidence so as not to overreact to the string of low inflation readings that we had in the second half of last year. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. That said, we think policy is well positioned to handle the risks that we face. If higher inflation does persist, we can maintain the current level of restriction for as long as needed.
Down to 502.
At the same time, we have significant space to ease should the labor market unexpectedly weaken. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Oh, yeah.
Well, thank you. I think that's a really
He's staying the
important frame
course
for our discussion today. One of the things that I remarked on when I first got into public life was how often I saw my international peers as we moved around. And when I see the two of you on stage together, I know that often you see each other at G7, at G20 meetings, and I think it would be quite interesting for the audience to understand, how collaboration happens or doesn't happen internationally, how central banks work together or don't work together. So, maybe I could ask you, Jay, to give a perspective on how that happens from your vantage point.
Sure. So to give you an idea, we do meet quite regularly. So Tiff and I attend 2 G7 meetings per year for ministers, that's finance ministers, and central bank governors. We don't attend the leaders meeting, but we attend, in the United States, but we attend the meetings with the finance ministers, which Bill was, and also 2 G20 meetings. So that's 4 meetings per year right there. We also have 6 meetings at the Bank for International Settlements in Basel. One of those is now virtual, but we're and that's only central bankers, no finance ministries. So it's all central banking stuff. And, it's economics, it's financial regulation, all those things. We also come here to Washington, or every 3rd year we go someplace else twice a year for the IMF World Bank meetings, which is kind of what everybody's doing in Washington right now. So it's a lot of meetings. What do we do at these meetings? Fair question. Essentially, the central bankers are having an ongoing conversation about what's going on in their own economies and their own financial markets, their own regulatory world with each other. And we're also talking about the big global issues of the day, as you would expect. So some of which are really the business of the elected government, not the business of the central bankers. But we have that discussion. It's more or less ongoing. We're seeing each other all the time. They're very informative, these discussions, and they really are, for me anyway, part of the way that I get to thinking about what the right policy is for the United States, is to hear what is going on around the world, what's happening globally, and how are people thinking about that. So it's very, very useful, particularly, though, given our close cultural, financial, and economic ties with Canada. Those discussions are especially fruitful and important, and I have regular conversations with Tiff. By the way, I do keep very close track of the actions of the Bank of Canada. I read Tiff's press conference transcripts carefully and pay close attention to that. Tiff did mention the similarities and differences. I'll say one more thing, which is we go to Basel, as I mentioned, 5 times a year. You're a long way from home, and we're there for 4 or 5 nights, and there are usually 1 or 2 nights off. So we go looking for someone to have dinner with, and very frequently we wind up with the Bank of Canada delegation who are really good and very funny and a lot of fun together. So we have a very close relationship with the bank and great respect for that institution, as I'll have a little more to say about lately. One other thing I'll point out, though, about our relationship is we did do, as Randy pointed out, our first review of our monetary policy framework really ever. And we looked around. The Bank of Canada also does regularly. I think it's every 4 years. In any case, we really looked to the Canadian model and other models of how to do that. We talked to people at the Bank of Canada about how their regular framework review went. So we really benefited for that. So that's what I'll stop there.
Tiff, similar perspective from Canada?
Yes, I'll just add a little bit on as Jay outlined, certainly from my perspective, one of the best parts about this job is we do, the international community, the central banking community, it's not like a commercial bank where you're competing against the other bank. We're all in this together. And if we get it right, we all help each other. So there is a considerable openness. And, as Jay outlined, I think there's a few different functions. Yes, obviously, if you're in Canada, we have our own group at the Bank of Canada that analyzes the U.S. economy, forecasts the U.S. economy. It's very important to Canada. But, the Fed's group is a lot bigger. They got a lot more experience. Hearing what the Fed has to say is incredibly valuable for us. The other thing we do, though, is it's more than just the data and the forecasting. It's thinking through the scenarios together. What risks are on your mind, Jay? What do you think could go wrong? What are the scenarios? How would we handle it if this happened, if that happened? Being able to put your heads together and think through the risks, the scenarios, the strategy. There are also a number of really, I would say, sort of behind the scenes, very central banky technical issues that, nobody really thinks about except central bankers. But, what are the mechanics of QE? How do you exit from QT? How many settlement balances are we going to need to, fortunately, those are things most people don't have to worry about. They are critically important for the implementation of monetary policy and the sort of plumbing working of the financial system, and being able to talk to people who are thinking about these things. I want to point out to you guys right now,
the Fed Watch tool shows we almost don't have any chance, zero now, for a rate cut in May. May, we are to stay. June, you can see that's changed a little bit. It's now 19.3%. So almost no chance of cutting in June. Just wanted to bring that up to you guys so you heard it here first. Rate cuts are still going down in likelihood.
And money flows across borders. So, we have to do that together or it's not going to work.
Well, maybe we can drill into that for a minute. Obviously we recognize that most of your work is focused on the domestic markets. But in times of crisis, there's real challenge, as you mentioned, in the COVID period, the global financial crisis, that you were engaged with, Tiff, earlier in a different stage of your career. And for me, it was remarkable the number of interactions with counterparts around the world during those crises. So maybe a question to both of you is, what kind of interaction happens during periods of crisis? What doesn't happen? Are there things that we should be thinking about differently in order to prepare ourselves for those challenging moments and making sure that the financial system is resilient? So again, maybe over to you, Jay, to react to that and hear your thoughts.
Sure. So, our economies, our financial markets, all of our institutions are deeply intertwined. And when there is a situation where there's serious stress, you need to get a global perspective. You need to get perspective around the world, and you have to do that very quickly. And we of course can move quickly and effectively on the domestic front. But the thing that you figure out in those times is that all the time you spent at Basel and at the G7 and G20 meetings, you know your colleagues, you know and trust and respect their judgment, and you don't have to go through that phase of gaining trust in people. You understand each other, you speak the same language, so there's a lot of communication. The level of communication is pretty high anyway, but during crises, it goes very high. I'm constantly talking to other central bankers around the world, and also political leaders in our government, and that sort of thing. So that happens a lot. The sense of what you're doing, again, is mostly sharing information and ideas about what to do. There may be a proposal that people are looking at, and you're talking about that. So it's very useful. I say one thing to point out is it's less about coordination than it is about talking and understanding, for one reason, or at least it was during the pandemic, and that was because almost every country's interest rates were very close to zero when the pandemic hit, and so there wasn't policy space for most economies, most central banks, to do a big coordinated rate cut. We did cut very quickly to zero, but I think we were higher than almost any other nation in terms of where our policy rate was. But anyway, there's a lot of communication, and those relationships that you built up really do help at that point. In terms
Sergio,
of
what up, big dog?
What have we learned?
Good to see you.
I think that the pandemic's going to teach a whole lot of lessons over time. I still think it's too early to say what they are with confidence, and I'll point out, look, the pandemic has surprised us over and over again, most recently in the United States, the remarkably strong performance of the economy at a time when virtually all economists were expecting a recession. So I think if you'd asked for the lessons of the pandemic a year and a half ago, you'd get a very different answer. Now, I think in a year or so, we'll have a lot more answers. It is a unique set of circumstances, and we're still learning, I think. But we will try to learn those lessons. Different point, I would say, about the bank stresses, another crisis, at least here in the States. I do think we can and have learned the lessons of the stress of early last spring. And I would point to a couple things that we embraced pretty forthrightly. One was that supervision was not tightly focused on the right things, was not proactive enough, was not forceful enough, and we've tried to take steps to remedy that. I also think there will be some regulatory initiatives for banks of that size and with those characteristics in time. So I do think those are lessons that we have learned.
And from a Canadian perspective, similar lessons or different ones?
Yes, I think there are similar lessons. Maybe I'll just give a couple of other examples. First though, I will just underline, when a crisis hits, you're faced with a situation. You have to make decisions, and you have very limited information. The other reality is you have a pretty narrow window to act to be really effective. And for both those reasons, being able to speak, directly to Jay, to connect with our other colleagues, finding out what's happening in their jurisdiction, how are they thinking about it, what do they see as the options. It is hugely important in a crisis. And that it's a little more, though, than just information sharing. I mean, I think it helps us avoid unintended consequences of our actions. Sometimes you do something and it works for most parties, but not one party, and in a crisis, it's the weakest link that can take you down. So you've got to be careful. It also, I think, boosts confidence in the system. If we're acting in a way that is coherent together, it boosts confidence. It looks more like a plan than a haphazard policy response. Just to give you a couple of examples, I wasn't actually governor at the start of COVID. Jay was there. But certainly looking at it from the outside, the coordinated actions of major central banks to reopen fixed income markets, providing liquidity, providing market making of last resort in scale, it restarted, reopened core functioning markets. And by all doing it essentially at the same time and all working in scale, the whole global market restarted. If that had not happened, this crisis would have been a much deeper and more severe crisis. And then the other one I'll highlight is coping with the inflation as we came out of COVID. By all being resolute in our commitment to restoring price stability, by all matching our words with forceful action, raising rates rapidly, we all helped each other. I mean, it helped reduce global inflation in goods, which was really the first part of the inflation surge, and it helped keep inflation expectations in all our countries better anchored. And I think it is a key ingredient in how we have all managed to get inflation down a long way back without causing recessions in our economies. And the last point I'll just highlight is something you said. Occasionally this coordination is very explicit. So for example, at the time of the global financial crisis, there was a coordinated G7 interest rate cut. I remember clearly because it happened at 3 o'clock in the morning in Canada, which was a little bit of a technical challenge. But most of the time, it's not explicit coordination, but it is those conversations. It is that shared information. We have similar objectives, similar goals, similar tools, and we're sharing information, and that leads to a coordinated response.
Well, maybe you could spend a little bit more time on that from the Canada-US perspective. So Randy mentioned in his opening comments the idea that when you're in Canada, you're living next to an elephant. And I think a lot of Canadians would assume that that Canadian policy has to take into account U.S. policy. So maybe could you give us a perspective into how important that is for your deliberations, and how that factors into decision making, the U.S. approach?
Well, look, I think it's pretty clear that our U.S. economic relationship is by far our most important relationship. Our economies are highly integrated. 35% of our GDP is exports, and 75% of that goes to the United States. So multiple, that's a big chunk of our GDP. Our financial markets are also very integrated. In fact, yesterday I was in New York, and when you go to New York, you are just reminded how integrated our markets are. I was at the New York Stock Exchange, and all over are cross-listed Canadian companies on many of the screens. Our financial systems are very integrated. Our banks have, most of our large banks have operations in the United States. Our pension funds are big investors in the United States. So we do spend a lot of time understanding what's going on, trying to understand what's going on in the United States and looking at the implications for Canada. There are, though, I highlighted in my opening remarks some differences. Another important difference I didn't focus on is, both our economies have big manufacturing sectors, big service sectors, large commodity sectors, but the commodity sector in the Canadian economy is quite a bit bigger than it is in the United States. Oil and gas, agriculture, forestry, mining, fishing. It's 40% of our exports, 13% of our GDP. And the commodity cycle can be quite different. And we have a flexible exchange rate that does help absorb the differences. And I think it's an important reason why historically sometimes our monetary policy do differ. Our cycles are often quite similar, and certainly through COVID we had a similar shock and a pretty similar cycle, and our monetary policy has been quite similar. There have been other episodes, though, where, particularly if the commodity cycle is different, you'll see monetary policy diverge somewhat from the United States. There are limits to how far it can diverge, but as I emphasized, we have our own currency, we have a flexible exchange rate, and that absorbs the differences to allow us to gear monetary policy to what we need to do in Canada.
And Jay, from your perspective, obviously the U.S. has an outsized role in the global economy, and I guess we'd be interested in understanding how much time do you deliberate on what your actions will have as reactions, and how much do you think about what's happening with global markets as you come to your conclusions?
So I'll start by saying that each central bank serves a domestic mandate, which is, in the case of Fed, is using our tools to achieve maximum employment and price stability for the benefit of the people we serve. So it's a domestic mandate. But in the case of the United States, we fully realize and appreciate that our decisions can have significant effects on, not just on Canada, or Mexico, but on countries around the world. And that's all the more so because the dollar is the principal reserve currency, which strengthens the transmission of our policy through the global economy. So we also know that those effects on global demand from our policy changes can have an effect on the United States as well. That can rebound to the United States. So we're very, very aware of all of that. And for one thing, we try to be very transparent and predictable, given the flow of data and events. I mean, you have to move quickly sometimes, but we do realize we have a special obligation to be predictable and transparent, and that benefits us in doing that as well. So international spillovers, of course, are an important consideration. We do track that. Ultimately, though, we think over time, the most important thing we can do to support the global economy is to deliver on our mandate of price stability and maximum employment here in the United States.
And is that, have there been changes in this current cycle that have driven any differences? I mean, you've talked about the different drivers for inflation this go around from previous periods of inflation. So do you think about it differently as you approach these things?
Yeah, well, specifically on inflation, I do think this is different. This is not simply the more standard case of overheated demand, which has been the typical thing in the post-war era for the U.S. economy and other major Western economies. There are similarities and differences, and I would characterize it this way, that the inflation that arose suddenly really in the early part of 2021 as economies reopened resulted both from constrained supply and also elevated and rechanneled demand from services to goods. So if you remember, and you I'm sure will, there were unexpected widespread shortages and supply chain failures on a scale not seen in recent memory. In the U.S., several million people had left the labor force, creating a severe labor shortage that was more fully felt once the economy reopened, leading to a huge spike in wages, but also in the ratio of job openings to unemployed workers. So, very unusual situation. Households had elevated levels of savings, and demand was very, very strong as well. So we thought, what's different is, have thought since we've understood the situation, that restoring price stability would require both the unwinding of the pandemic-related distortions to both supply and demand, as well as the effects of tight monetary policy on demand, which would give the supply side time and space to recover. And we think today that we're seeing those two things working together to bring that end about. And you saw that, I think, in 2023, which was really, in a large way, a supply-side story. What happened was the supply side really recovered in 2023. We thought that it would recover in 2021, and in 2022, I was beginning to lose hope. And then in 2023, you saw the shortages and the issues with the trade pipelines not fully resolved, but largely resolved. You saw the U.S. labor force shortage alleviated by both higher participation among people who had dropped out of the workforce, but also from immigration. So that was the year of the supply side recovery. And you saw the core inflation rates drop by 2 full percentage points in the face of very strong growth. So that can only be explained by the enormous increase in potential output, supply side increase over that year. So that's how I would say it's different this time.
And Tiff, maybe you can tell us how it's different in other ways in Canada. So we were talking about the similarities and the similar approaches to dealing with inflation and the positive results. But we've seen a divergence in Canada with respect to growth. So clearly there's some differences too. Maybe can you reflect for people what those differences look like and what the ramifications are for you?
Yeah, I will focus on the differences, although I will stress I think the main story is the similarities. And as Jay outlined, what is so unique about this whole cycle is that supply has played a much bigger role than we're used to.
Yeah.
And from a monetary policy perspective, we don't have as good line of sight to supply as we do as demand, and we don't have any tools to influence supply. Our tools work on demand. In terms of what has been different, if you look at the Canadian economy, growth was essentially zero in the second half of last year. And what that meant was the economy, which was very overheated, supply caught up with demand. In fact, it more than caught up with demand. The economy moved into excess supply, and we're now seeing the effects of that in terms of relieving price pressure. So, why did demand slow more in Canada and the United States? I think that is a difficult question. I pointed to a couple of things in my opening remarks. I think productivity growth in the United States has been a lot stronger. You've gotten more supply than we have, so you've been able to grow more with less inflation or less inflationary pressure. And then the second thing is I think monetary policy is having more traction in Canada because the structure of our mortgage markets, half of mortgages have renewed in Canada. And even if your mortgage hasn't renewed, it's renewing in the next couple of years probably. So you're thinking ahead, thinking, oh, when it renews, I'm going to have to be paying a lot more on my mortgage every month, so maybe I should be saving more money now. So we're seeing that effect. We've had weaker consumption growth. And certainly that's been somewhat masked by the fact we've had very rapid population growth. But if you look on a per capita basis, you can see household spending per capita, per family, has actually gone down, even though growth has not been negative overall. I think moving forward, we are actually seeing growth starting to pick up. The first quarter of this year looks pretty strong. Probably see some choppiness quarter to quarter, but overall we think that strength we're seeing in the first quarter will be sustained through the year, where we think on a quarterly basis growth is going to be averaging about 2% per quarter through this year. That's partly we're starting to see some pickup in consumption. Partly it is the resilience of the U.S. economy that is supporting our exports. They've been very resilient. And then coming back to inflation, I think those, broadly speaking, the path of inflation is pretty similar, but you are seeing, I think, some of those differences in the dynamics of the real economy in inflation. Our last few inflation readings have been reasonably good, even though total's still close to 3. Core has been, the last few times ticking down, and if you look at the more timely 3 months measures of core inflation, there is some downward momentum in underlying inflation, and I think that reflects the fact the economy is in excess supply, and that is relieving those price pressures. We're certainly looking for evidence that's going to be sustained. That's what we're looking for right now.
Well, I know that that both of you realized that one of the key things we were trying to emphasize today was the importance of the Canada-U.S. relationship. And I also really appreciate all of the comments on the importance of trade to both of our economies, trade between our two countries, and foreign direct investment. And so while you're not trade policy experts, and I get that your organizations, that's not the focus, I really appreciate you giving us a little sense of, how do you think about trade in economic terms and the importance of that, and how that factors into your economic outlook. And specifically, we're thinking about the importance of the agreement between the United States, Canada, and Mexico, and wondering how you think about that in terms of its impacts on trade in general, on labor markets, on supply. So maybe I could ask you, Jay, to give us any reflections that you might have on that and deliberations impacts.
So I guess I need to start by saying we don't do trade policy. We don't really comment on trade policy other than to say that it's clear that we have a mutually beneficial, large, substantial, ongoing, healthy trade relationship with Canada that we very much welcome. Maybe I'll add one more thing, which is I want to focus on a particular export of Canada that I think somehow we just desperately need here in the United States, and we can't get enough of it. And that is Canadian comedians and comic actors. I started to count the number of really great, funny people, and I limited myself to 10. So Jim Carrey, Martin Short, John Candy, Mike Myers, Norm Macdonald, Rick Moranis, Dan Aykroyd, Catherine O'Hara, and Andrea Martin. And I could go on. So something's going on up there. Americans love Canadian. If that's Canadian humor, we absolutely love it. So send more. We can't get enough of it.
That's a small but important part of our trading relationship, I guess. Tiff, all jokes aside, any comments from your perspective?
Yeah, well, first of all, as Jay underlined, we don't set trade policy, but let me just say, try to give you more of a picture. I mean, first of all, you just look at our two countries. The east-west border is the longest border in the world, and it's a long way across Canada. So it often makes a lot more sense to trade north-south than to trade across the country. And that's really, it comes down to geography in some sense. I mean, that's fundamental to the interties we have across our countries. Many Canadians are closer to fellow Americans than they are to fellow Canadians, just the nature of the geography. You look at what are the things that we buy and sell? Well, some of the biggest things, in Canada, we buy a lot of your consumer goods in the United States. We have a very two-way relationship on motor vehicles. You buy a lot of the motor vehicles we produce. We buy a lot of cars and trucks that you produce. Similarly, energy. We're both energy producers. It often makes more sense to trade the energy north-south than to ship it across the country. So we have a very dynamic two-way energy relationship. And you look forward and you think about how much electricity the world's going to need. I expect that relationship is only going to grow. Another element that is growing quickly, and maybe that's partly comedians, is the fastest growing part of trade is trade and services. Now, if you want a haircut, you still have to do it in your own country, unless you want to go to New York to get a really fancy one. But but increasingly, a lot of services are highly tradable. The internet has completely changed how many things are delivered, and so you're seeing Canadians are increasingly importing a lot of commercial services from the United States. And then the final thing I'll say is on USMCA. Obviously, for both countries, the market access is key. The other thing I would underline, though, it's also the certainty about the market access. The certainty that American companies have that they'll have access to Canadian markets and Canadians will have access to American markets. That allows businesses to make investments, to deploy their risk capital, to commit to the future. And it's that certainty of access that is really key to building investment. I'll stop there. Thank you.
Well, I'd like to thank both of you for taking some time with all of us. I think if we had looked back a couple of years ago and reflected on what we were thinking back then might be the trajectory of our economies, we probably wouldn't have had an expectation that we would have been where we are today. We would have expected more challenges than we've faced. And I think we need to recognize that the stewardship that the Federal Reserve in the United States and the Bank of Canada in Canada have been responsible for has made an enormous difference in citizens' lives. I mean, we're in a situation that is virtually our best case scenario. So it's probably not often enough that on stage you're recognized for that important work, and I want to thank both of you for all that you're doing for all of us in making that the reality. And also I want to thank you for taking some time here. I mean, we are reflecting on the fact that in a couple of years, the U.S.-Mexico-Canadian trade agreement will be looked at again. And we want to reinforce the importance of working together, the importance of collaboration and cooperation, and really great trading relationships. So this is an important way for us to start this off, seeing the collegiality between the two of you, knowing how well people work together is really important for people. So thank you very much, and I know it's a busy week for you, so we appreciate also taking the time during this busy week. So thank you. From the Canada Institute, I'm going to ask Zabi Delgado to close off our session today.
Thank you, Bill. That concludes today's program, everybody. Thank you all, everybody in the room and online, for joining us today. I also want to give a thanks to our very esteemed panelists and our co-chairs.
All right, guys, so that kind of sums it up for you right then and there. Just a few things that I wanted to go over when it came to the overall, let me grab my microphone here so you guys can hear me a little bit better here. I want to make sure we're not going too loud here. But so that was great. What I seen mainly was the same talk, right? Fed Chair Powell still remains committed to bringing those Fed interest, I'm sorry, not the Fed interest, but the current U.S. inflation down to that 2%. Currently, we are sitting at 3.5%, and I can bring this up for you right here so we all can get a better understanding of what's going on in the overall market. So right here, I have pulled up for you. You can see in 2004, we had inflation rate of 0.8, and we've been slowly going up until 2020. We had 0.4. Then COVID happened, and the inflation rate went up to 7, right? Okay, now that is not ideal. That is very, very scary. So what Papa Powell keeps coming out and trying to say is he remains committed to bringing that back down to 2%. Okay, so if it's at 7, we're going to raise those interest rates. Okay, and he raised those. Now he's at a stay. So May, if we look at the overall interest rate, we plan on staying. So here's the Fed tool, right? This is another thing I use to help show you guys. This Fed tool shows that in May we are to stay, meaning 3.5% is going to be the expected May Fed hike, right? We're not hiking, we're staying. That's why I keep saying May to stay at 3.5. So we can continue to bring this interest rate down lower. I'm sorry, inflation rate, damn it, down lower, okay? So that being said, let's take a look at what's going on this year. This is why we are getting a big push up. And then now we're starting to see high CPI, high PPI, and more jobs out there. People are still working. The economy is still strong. So it's scaring these people thinking we aren't going to cut those rates. We are not going to bring them down by the end of the year. We are not going to get those 3 rate cuts that everybody was so expecting. And you can see in the Fed rate tool that we aren't going to get those cuts. And here's why. At the start in January, we were at 3.1%. At the end of last year in 2023, we were at 4.1%, and then the inflation rate came down to 3.1% in a short amount of time. Then in February, we showed it went up just a little bit. It wasn't scaring the market. In March, it was showing we went up just a little bit more, and the market started to get weary. Now that we have from March until April, and April until May, right? We don't get April's decision until May. But people are very fearful that the overall market is going to head back down because the interest rates are because we're not going to get interest rate cuts because the inflation is so high, okay? So if we continue to ramp up and we start heading up higher, that's not good. Papa Powell is going to ingest this data and he's going to say, no way, this isn't going to happen. We are not going to cut rates at all this year, and it might be a big issue. Now, when we have this on the 1 minute, and if you guys look right now, we are in an area of resistance at this 505.26. And it looks like the overall market has ingested this data. We had a huge red pullback on higher volume. Now it looks like we are ramping up and we're starting to try and get above today's high. That's a beautiful outlook for the S&P 500. Let's go ahead and look over here at the QQQs. QQQs are doing the same thing, ramping up, starting to head to the north side. So things are looking good. Maybe we're going to ingest this data as something more positive. Now, one thing I do want to bring up while you guys are still here, if you look at my screen, go ahead, hit that like, hit that subscribe button for me. I bring you bite-sized data so everybody can learn and understand from it. So if you don't have time to do as much studying, as much ingesting of all of this as I can, holy cow, you're seeing it live here. We're getting a huge bump up here, ripping up, rip, tater chip. The market is going skyrocket to the north side. That's a beautiful sign for the overall market. Let's go ahead and move back on the 1 hour here so we can actually see where we are sitting here. Okay, if you're wondering what the gray is, that is pre-market data. We are moving higher. Things are looking very, very good in the market right now. But let me tell you something. Right here is resistance, okay? If you look back here on the hourly, 1, 2, 3, 4, 5, 6 different times now, we smacked into this area. So this is a big key area of resistance at 433.36. So let's be very, very careful right here, guys. I mean, this is exciting. It's good to see the market go higher, but we also need to understand that we are in an area of resistance. So be very, very careful in the QQQs. Also, let's go ahead and look at the S&P 500 and see where that resistance is. Now, with this resistance, we could still go a little higher. The resistance, we did break through previous resistance, but I think 508, it's its next resistance area. So I'll just go ahead and mark this out. We can see we've hit this area quite a few times in 3, 4 different areas. We've hit this area. So S&P 500 looks like it can continue higher in this area, but the QQQs are right at a resistance area. If it can break back above this, this is the 50-day moving average. If I remember correct, let's go ahead and take a look at, no, not in the QQQs, but the S&P 500, this is probably getting close. Yes, it's starting to bearing in on that 50-day moving average, but we still have a long way to go. 510 is actually that area, so we still have about $4 to go until we'll actually hit that area. So let's make sure we pay attention. Now, guys, one thing we want to look at, thank you, Predator, the poll. The poll shows that after the speech, where will we head? 504.45 is when I started this poll, and right now, most of us, the majority of us, at 61%, decided that we were going to actually end up going lower. So we're going to go ahead and end this poll so everybody can see where we actually were at on that. Actually, very interesting to see. 61% guessed that we would be lower, and right now we're $2 higher than where we were at when we first started this market. So Papa Powell came out, didn't drop the mic this time, didn't smile, as Predator was saying. If we smile, we're going to have some issues there. So I really hope I brought some form of entertainment to you guys. If I brought any entertainment or any news that you could ingest, and we talked about the inflation rates back from 2024 to 2014. We talked about the Fed tool rate right here that we use constantly. We know in May we're going to stay. In June, we have less likely percent of chance of actually lowering those interest rates even by a quarter in June. We won't actually get that until around July is where it starts to bump up. 36% chance of actually coming down a quarter of an interest rate percentage in July. We actually don't really start seeing any kind of interest rate, and it's still not 50%. 46% of your panelists say that we might come down a quarter of a interest rate percentage in September, guys. September. So we're looking pretty far out here. So if any of this information, any of the data and analytics, any of the the technical analysis that I brought you today has helped you in any way. If you're learning from this or just simply entertained at all, please hit that like, hit that subscribe button. We are trying to grow this community just even quicker. Every day it seems like we are getting more and more people out here, and things are just absolutely beautiful. I love growing this community, and I hope you guys love growing it with me. So thank you guys so much for joining me. So we'll stick around for a little bit longer in case anybody has any questions, comments, concerns. Other than that, Papa Powell came out, man. The biggest thing I took from it was Canada's having the same issues as us, right? So Canada, and they're so close to us, and we have so much trade with them. That's one of the things that they brought up, that Canada and the U.S., we have, an even balance of currency coming in between each other. So it's great. It's great for our trade. It's great that the dollar is going back and forth. We're getting all them beautiful Canadian dollars coming, and they're getting our dark green dollars coming back to them. The car trades, the foods, everything like that is getting traded back and forth. So it's very nice to see. They're also having the same problems as us, right? So we're getting a lot of people coming in from Mexico, from the borders. We're getting a lot of people coming in, and they're creating more demand, right? When we have more people, we have more demand. And when we have more demand, we need to produce more supply. So it's creating a radiant economy. I mean, it's absolutely beautiful to see, but it's hard with sticky inflation, right? So when you have the sticky inflation out and you're trying to bring it down while trying to keep a boosted economy, it creates this significantly odd factor in there where how do you raise interest rates or keep them where they're at while lowering inflation while the economy's still booming? We're still needing people to work. We still need jobs. We're still trying to attest for everything that's going on. So I tell you, Papa Powell, I'm glad he's a lot smarter than me, because it would be very hard for me to take in all this data and try to ingest it. I'm glad I just have to report on it, right? So I think he did a great job staying the course. He did not come out nearly as dovish as I honestly thought that he would. Not nearly as dovish at all as I thought Papa Powell was going to come out and act. He actually, if anything, he came out pretty hawkish, saying we will stay the course. We will reach our 2% on the inflation. We will stay the course. So that when he comes out and says that, and we are continually going up in PPI, CPI, all that stuff, then it's very, very clear to me that he's going to stay the course, right? So we aren't going to cut those rates anytime soon until we start seeing that 2%. Once we start seeing it gradually come back down again, that's when we can trust that that things are going to start to come down in the Fed rate hikes. So one thing I want to look at is my trade. So the trade I took today, the opposite of an earnings gap up runner, I decided to take on a 1-minute opening range breakout, was this UNH, United Healthcare. I had a multitude of reasons for taking that. If you want to be a part of our opening in our Discord, I actually called this out in Discord. We're up about $161, and we made about, I know guys, it's just chump change. We made about $70 in the NVIDIA short today. So between the two, we're up a little over, $200. We're about $230 today. My goal is to make $500 a day. $500 a day keeps the job at bay, right? But no, I do like to achieve my goal of $500 a day, but it's not always there. And I'm not going to chase. I'm not going to fight. I'm not going to fret. This trade is for a swing trade, so I'm going to be holding on to this for a while, because if you use stage analysis, this looks like we were in a stage 3 up here, and now we're in a stage 4. So once we got a nice pop on this, I expect this to continue lower. I'd like to hold out on this into the stage 4 until we start to see a stage 1 start to form again. Once we get a nice base, a basing in UNH, that's when I will exit this trade. And if you want to be a part of that, just join our Discord. We go through it every single morning at 8 a.m. We talk about exactly what our thoughts are in the overall market. We give you a sense of direction. If anybody can tell you exactly which way the market's going to go, they're wrong. They're lying to you. They're a guru. I'm not here as a guru. I'm just a data. I do data analytics. I do market analytics, and then I give you the reins. You're there to learn and understand risk management. We try to teach that. We give you ideas. of these plays, but these aren't buy or sell recommendations. We want everybody to grow in their own way, to learn to be positive and anchored traders so they feel confident taking their own trades in the market. So make sure if you are interested in any of that, we are coming out with a free course as well. That will be released very, very soon, I would say within the next month or so. But other than that, we give bite-sized data. So hit that like, hit that subscribe button. We appreciate every single one of you being here. And thank you for joining me today. So, you guys, thank you. I appreciate you just as much as I hope you appreciate me. We're going to go ahead and end it on there. So thank you so much. Nothing but love. This was a great stream. Thanks for all the likes. It looks like we got up to 17 likes. That's a record. Maybe. I don't know if it's a record or not, but we're going to keep shooting for higher and higher goals because each time we stream, we end up getting more people in here. We end up getting more likes. So thank you guys so much. I hope you had an awesome time, and we'll see you on the next one. Peace.